All right, I'm here today with Nate Hare, a fellow Auburn alum, which we found out last time we spoke, so that was cool. But he is an expert in something that I think is fascinating, which is self-directed IRAs. So honestly, I think it's something that the average American knows hardly anything about, and it's interesting that that's the case. I mean, I personally minored in finance in college. I never knew about this till recently, so it is not something the industry likes to talk about, and I think you'll probably agree with this, but it's because of the freedom it allows people to control their own money. So, Nate, I appreciate you taking the time and sitting here and talk with us today.
Yeah, I appreciate you having me on. And yeah, like you said, I mean, not enough people know what a self-directed IRA is, and it's just because we're not taught it in school. I went to an MBA program. I mean, I went accounting classes, finance classes, business management classes. There was maybe a smidge of content on IRAs in general, but not self-directed IRAs, and not even when I got into the corporate world did I even hear about it. I had to get recruited by a self-directed IRA company. It was the first time I heard even the term, and when I learned about it, I thought, okay, I should have known about this 10 years ago. And that's when I went full steam ahead into the industry, because I just feel like more and more people need to understand that this is out there, and it's powerful.
Yeah, it's pretty incredible. I mean, I don't know the exact statistics. You might be able to help me out on this, but the amount of people who have money in a retirement account essentially getting 3 or 4%, like next to nothing. It's mind-boggling. I think it's like well into the billions of dollars across the country, and there's so many better things to put it in. So it's really cool what you guys do.
Yeah, I mean, it's not even billions, it's trillions. So there's 45,
Trillions.
yeah, $45 trillion in retirement plans, about 17 trillion in IRAs. And most of that money is invested in what we call traditional investments, right? Wall Street, stocks, bonds, mutual funds, ETFs, which are not bad investments. I would never say any investment's bad. It's just really about, do you understand the investment, right? And do you know what your other options are? The problem is most people think that's the only option they have. That's why they invest so heavily into the market. And of that $45 trillion, 97% of America's retirement is invested in Wall Street. And they're getting killed right now. It's not that 97% of people believe in Wall Street. It's that 97% of people think that that's their only option. That's the only reason that that number is so high. And, I like to teach people it's not about, the investment. It's about how do you invest, and invest in what you're knowledgeable about. That's where I see people take self-directed IRAs and make them powerful, because they can take the money and invest in what they know, which could be real estate, cryptocurrency, private businesses, private lending. I mean, there's all sorts of investment opportunities that can be owned in a retirement account. People just don't know about it because they're never shown it, and they're constantly sold investments through their Fidelities or Charles
Yeah.
Schwab's.
I think you just hit it on the head. It really comes down to the motivation. Like, what is the motivation of a company that gets paid to basically hold on to your money to tell you about other options? It's pretty much non-existent. So that's a pretty good segue into just kind of the basics of what is a self-directed IRA, and how is that different from what people think about when they think of a Roth or 401k and that sort of stuff.
Great question. Get it every day. And we use self-directed loosely, and I will tell you, it is not a type of IRA. Self-directed is just a marketing term. If you're talking about an IRA, we're talking about an individual retirement account. That individual retirement account is governed by a certain set of rules. Okay? Those rules are the same no matter where you park your IRA. What changes for people is the company you park your IRA with, sometimes they have investments that they prefer to sell you. This has nothing to do with what's allowed in an IRA. This has to do with the fact that your Fidelities, your Charles Schwab's, your Merrill Lynch's, they're licensed securities brokers. They sell investment product. So if you have a retirement account with them, they're only going to let you hold what they sell, because that's how they make money. But when you look at the tax code, right? When you look at publication 590 of the IRS tax code, okay, this is what dictates, how a traditional IRA works, how a Roth IRA works. IRC 4975 that talks about the investment options or investment restrictions. You'll find you can own almost anything inside of a retirement account besides life insurance contracts and collectibles. That's it. Those are the only two investments the IRS says we don't want that in a retirement account. So if you think about the number of investments that are out there outside of just those two, we've got rental properties, multifamily, commercial, syndications, oil and gas, mineral rights, right? Cryptocurrency. I mean, the list goes on. And all of those investments can be owned in a retirement account. You just can't do it with your Fidelity IRA. You've got to do it with a company like us, who's a licensed custodian of retirement accounts, but we don't sell investments. We're not a securities broker. We're not licensed to sell you anything, but we are licensed to hold assets in retirement accounts. So when you have an IRA with us, directed IRA, we say, tell us what you want us to buy, and we'll buy it in the name of your IRA as your IRA custodian. But you've got to show us what the investment is. And that's where the self and self-directed comes from. So a lot of our clients, let's just take the, most basic avatar, a real estate investor. A real estate investor, they know how to make money buying and selling real estate more than they understand the stock market. So if we have a real estate investor that understands real estate and they want to own a rental property in their IRA, they can do it. They just have to have the IRA with us, and we have to buy it in the name of their IRA. They've got to go find the property. They've got to negotiate the terms. So it's a little bit more of an entrepreneurial type of account because you're more active, but some people are better in that role. And if you think about real estate in general, where multiple streams of income, it appreciates over time, and all of that income can come back to an IRA and you pay no taxes on it. I mean, this is where it blew my mind, because I had 17 rental properties, all owned in my personal name. And had I known I could have been buying property in my IRA and pay no taxes, I would have got further down the trough, because, I was paying taxes on all of my income. I didn't get far enough, but these self-directed IRAs allow you to get further without paying taxes on your gains, whether it's stocks or real estate or anything else.
Right. So basically the difference is, like, if you went to one of the traditional, what you call traditional retirement places, you tell them, hey, I want to invest some in real estate. They're probably going to put you in front of like a REIT or something along those lines. Not real. I mean, REITs are basically just corporations that own real estate. It's not really owning real estate. So when people come to you, you don't suggest anything. You're basically, hey, I want to invest in this. So that's where the difference comes in. It just comes down to how you guys are structured. You have no incentive to recommend an investment to an investor because you guys don't make anything from that.
No, yeah, we don't make any money on the investment. Now, we do have some fees for administrating the account and processing paperwork. I mean, we have people that have to sign documents. There's transactional, fees for us. But as far as what the investment is, we could care less. And in fact, we're supposed to be passive. I love to tell my clients sometimes their deal looks a little shaky, but I'm not licensed to tell anyone what they should or they shouldn't invest in. Again, that's the role that we play. We're the passive custodian. The client tells us. All that we say is, yes, you can buy that in your IRA, and here's what we need to buy it. Right? Here's the documents that we're going to need as your custodian so that we can buy it and own it in the IRA. And one thing that people have to get past is, your IRA is a separate entity from yourself. It's not your money until you take distribution. So, which is a good thing, because your IRAs are tax exempt trusts by nature. They grow tax free. So what you invest in can be life changing. And just understanding that you can invest in things that you're maybe more knowledgeable about than the stock market could be the way that you get to retirement 10 years earlier than maybe your current path.
Right. And so for most people, they've probably got a retirement account now. I think most Americans who are out there working, listening to something like this, they've got a retirement account. Do they have to start fresh when they do a self-directed IRA? Is there any way that they can take what's already invested in those and roll it over?
Yeah, great question. So most people, I think about 65 to 70% of people have some sort of retirement account, whether that's a 401k, a 403b, 457 plan, a TRS, a TSP, an IRA. So most people have that type of plan. And you're not limited on how many retirement plans you can have. You are limited on how much you can contribute each year, but you're not limited on how many plans you have. So for instance, most of my clients have an IRA here at Directed IRA that holds their what we call alternative assets, all the things that not tied to Wall Street. They have an IRA here, but they also still keep an IRA at Fidelity or Charles Schwab. I have a client that has 35 IRAs, right? Parked all over the place in different assets. I mean, he's all about diversification. So he gets as many IRAs out there invested in other things. Now, I'm not saying you have to go that crazy, but it is probably wise, I would say, from an overall perspective, to have at least 2 IRAs. And I'm talking 2 traditional IRAs, 2 Roth IRAs, because when you have let's say a traditional IRA at Fidelity and a traditional IRA at Directed IRA, now you have retirement accounts that can invest in traditional assets and alternative assets. Same thing with a Roth. Same thing with an HSA, right? So if you really want diversification, you want to have your money parked at different custodians that will allow you to hold different assets. That's how you get real diversification.
Nice. So I hear a lot of people when it comes to real estate investment, when it comes to retirement, a lot of it gets pretty confusing with all the jargon and whatnot. What it might be, what I want to ask is basically what accounts can you roll over into a self-directed IRA, but it might be simpler to ask what accounts can you not roll over. So which do you think would be
Yeah,
easier?
that's a good question. Yeah, I guess I'll answer it. The hardest ones to roll over are the ones that you have with an employer that you're still working with. Those are the hardest ones to move because most employers, if you're working a W-2 job and you've got a 401k, they're going to have provisions in your 401k docs that prevent you from moving money out of that plan while you're still actively employed with the company. Now, there are certain plans that are a little open-ended. If you've worked at your company for a lot of years, if you're above, age 55 or 59 and you're fully vested, then there might be some provisions that allow you to move some money out while you're still employed. So that's usually the hardest ones to move, is the ones that you're still actively an employee of the company. But if you've left the company, if it's an old 401k, it's an old 403b, an old TSP or something like that, 99.9% of the time, that old plan can be rolled to an IRA anywhere. So you can roll that into a self-directed IRA. And if you have a old plan that's already been rolled into an IRA, a lot of people call this a rollover IRA. A lot of times they're just traditional IRAs under the surface of it. But if it's already been rolled to an IRA somewhere, IRAs can be moved back and forth between other IRAs very, very easily. That's actually the easiest way to move money between retirement plans, is when you already have an IRA. So if you already have an IRA at Charles Schwab, and let's say it's a traditional pre-tax IRA, you just open a traditional pre-tax IRA here, fill out a transfer form, and wire money. We don't even report it to the IRS. IRA to IRA transfers are not even reportable transactions. So you can move money back and forth very easily between IRAs. But if it's an employer plan, like a 401k or 403b and those other plans I mentioned, those need to be rolled over, and easier to be rolled over if you're not with the company anymore.
Gotcha. And last time we spoke, you had shared a story about the difficulty of doing this. And in reality, it's a pretty simple process, but it kind of depends on if people go to you first or if people go to their current retirement accounts first.
Oh, yeah.
When my wife left teaching, we did this, right? We use you guys and we switched over the process. And I had met somebody from your company and they told us, hey, reach out to us first. So we did. We sent the documents. It was pretty easy. And then would you mind sharing the story of what you typically see when you don't do it in that order?
So let me tell you the specific story, and this is from a client of mine. So and this, I've heard this story many, many times, but she told it very well, and it was very recent, so it's fresh on my mind. So she found out that she can self-direct her IRA, and she had an IRA at Fidelity. So she wanted to basically move the funds from Fidelity over to Directed IRA so that she can self-direct, because she's a real estate investor, right? She understands real estate. So she picked up the phone, she called her Fidelity guy, and she said, hey, I'm opening a self-directed IRA, so I need to find out what you guys need so that you can move this money to a directed IRA. And her advisor said, oh, no, you don't want to do that. Those are really risky, right? And he goes, those are really risky. Didn't even ask her what the investment was, didn't ask anything, just heard self-directed IRA and said, no, you don't want to do that. Those are risky. And she said, well, I think I'm a good judge of my own risk, so just tell me what you need to move this over. He said, okay, well, it's very hard. There's a lot of documents. It's going to take 2 weeks and all this. She goes, can you at least get me the forms by 5 p.m. tonight? So he gets her the form. She fills it out. She sends it back. She follows up the next morning and she goes, okay, you told me that there was a bunch of steps and I sent you the form. What else do I need to do? And he goes, oh, that's all you needed to do. So after all that, it was easy. He was just, the point that she was making was he was trying to talk her out of it without even knowing what she was invested in, because he has a vested interest to keep the money with him, right? Where she has a vested interest to make her retirement grow. And that's, I think, where most people's heads need to be. And that's why I enjoy this industry, because I'm not selling an investment. I don't care what the client invests in. But I do like the ability to show people, hey, here's the types of IRAs that you can invest. And here's the other cool thing. These IRAs are great tax-free vehicles for generational wealth. Understanding them has changed my life, because now I understand how the rich get wealthy. It's by understanding the playbook that's there in the tax code to help eliminate taxes from our life. So if we can invest in what we know best and pay no taxes, that's how we get to retirement. But everybody else is just being sold a pipe dream and saying, just invest with the stock market, let somebody else do it for you. If that worked, we wouldn't have people working way past retirement age, and we wouldn't have, the average retirement plan being $100,000, because nobody can retire on $100,000 these days. So you got to invest your way to retirement, and you got to invest in what you know best.
Right. So in terms of investing in what you know best, I have heard this may be a myth and maybe not, that you can't actively manage a property that you have through your IRA. So is that correct or is that incorrect?
So there are some rules, and really the purpose of your retirement account is to invest it in a tax-free manner so that you, the account owner, can live off the distributions, right? So the IRS is a little bit, they don't care what you own in the IRA, but they do care about how active you are with the assets inside it until you take distributions to yourself. So for example, let's say my IRA owns a 3-bedroom, 2-bath rental property, okay? Now that rental property is owned in the name of my retirement account. All the rental income must go to the retirement account because it's the owner, right? All the expenses need to be paid from the IRA account. Okay? That, I'm just oversimplifying it. There's easier ways to do it, but money needs to go in and out of the IRA. Now, your role to your IRA is you are still the fiduciary to your plan, meaning you have to make decisions that benefit the plan. Now, if you're just using your brain, right, I'm picking the property that's owned in my IRA, that's fine. That's a fiduciary job. Can I pick the contractors that work on the house? Yes, that's a fiduciary job. I'm quarterbacking the deal. I'm making sure things operate in my IRA. Can I be the contractor? Can I be on site, on the property, building a 3rd bedroom on the house or a 4th bedroom? No. The IRS says we do not want the IRA owner to be swinging a hammer or actively, what we say, managing it. Managing it's a really gray. You can manage it from a quarterbacking standpoint where I'm putting people in play, but I can't be an active property manager and get compensated for that. So there's a little bit of a fuzzy gray area there. Again, your IRA is not going to do things by itself, but you are allowed to be a good fiduciary to your plan. You just got to be careful about being too active where the IRS thinks you're extending services to your plan, that you're getting compensated for it. That's a definite no-no. But as long as you play by the rules and you're passive and you put people together to help your retirement account grow, that's not you, then you're perfectly within the rules. So hire contractors, rent it to people that are not you. You can't rent it back to yourself. You can't rent the properties to family. There's certain things that you and certain family members cannot do. But as far as being a fiduciary, there are some things that you have to do. I would say that.
Gotcha. I honestly am a loophole guy, and where my head immediately went to why they probably put that rule in, what's to stop me from paying myself a 20% management fee? So, and which would be earned income. So I could see why they do that. So let me give you a real world example. So I'm in the mobile home park space. When I buy a deal, I'm not the property manager. We have a property management company that handles that, right? In this case, a third party. I'm unaffiliated. Is that good? That could be, I could own that through my retirement account?
Oh yeah. As long as it's a third party that's doing the management. Same thing with businesses, right? My IRA can own a small business, and I would make the argument some real estate investments are businesses, right? Mobile home parks, self-storage, sometimes those are looked at, that's kind of like a business. Somebody's got to run it in most cases. So when it comes to the management or the daily activities, it has to be done by what we call a non-disqualified person, right? Disqualified people are the ones that IRS says, we don't want you guys being active managers of the assets. And the disqualified people that are not allowed to manage assets like that would be the IRA owner, the IRA owner's spouse, their parents, their kids. That's pretty much 99.9% of them. So if I have an investment that needs to be managed, it needs to be managed by somebody other than those people. So it can even be a brother, a sister, an aunt, uncle, or just a licensed professional that's not you, your spouse, your parents, or your kids. And you're fine. You're perfectly within the rules as long as you get those key, players to help manage your assets.
So you, your spouse, your parents, your kids. So basically, direct lineage can't be involved in management. Okay.
Yeah, and the
Got it.
reason why it's those, because if you think about when you die and how an IRA moves as an inherited IRA. And most people leave their assets to their spouse or their kids. So those people are going to normally have your IRA when you die as an inherited IRA. So the assets will be theirs. So that's why they say we do not want those people that are in the line of inheritance to be actively managing the assets in the account because the account will be theirs at some point. But brothers, sisters, aunts, uncles, cousins, nieces, nephews, they're normally not in the line of inheritance, so they can be active managers and transact with the IRA. Now, however, I will give you a caveat. I'm not married and I don't have kids. So on my beneficiary form of my IRA, I do list my brother. Because he is the beneficiary, he becomes a disqualified person. So it really just comes down, the IRS just says if it's your account or the account's going to go to that person, we don't want that person actively managing the assets or being involved to that degree. So that's if that makes sense to people.
Yeah, that makes total sense because it immediately could just be like, hey, you're my brother. Look the other way. I'm going to manage this, kind of thing.
Right.
So,
Right.
Gotcha. So let's say you already have a property and it's not in an IRA's name. It's just your personal name. Can you transfer that into an IRA?
Unfortunately, no. So this goes back to what the IRS doesn't want us doing with our IRAs and specific to the people. So if I had a rental property owned as Nate Hare's rental property, right, I'm not allowed to sell that to my IRA. Because remember, I'm the decision maker for the IRA. Who's going to tell me no? And people say, well, what if I do, sell it at fair market value? The IRS does not care. They do not want self-dealing because it's a conflict of interest between disqualified people and IRAs. So if you have assets that you already own personally, you own them personally. But if you want assets owned in your IRA, that has to be done with new assets that you find, right? That you self-direct, that you find. If you find a new rental property and you say, or a new investment and you say, okay, I don't want to own this as Nate Hare, the taxpayer. I want to own this as, directed IRA for the benefit of Nate Hare's Roth IRA, the non-taxpayer. Right? That's why you set up an account with us. That's why you move some funds over to us and then tell us, this is the property that I want my Roth to buy. And then we'll tell you the documents we need to buy it. And as long as we're buying it from a non-disqualified person, then it's perfectly within the rules. So you need to direct your IRA to buy new assets, and those assets have to be bought from non-disqualified people. Unfortunately, you cannot sell your own stuff to your IRA.
Gotcha. That's interesting. Okay. So if people are I'm in the real estate space, so we see a lot of pretty much deals kind of tend to follow a similar cycle, right? We buy it, we get monthly or quarterly distributions, we either refinance it or sell it. So let's say we put our money into the deal as an IRA. Those distributions have to go to the IRA and stay in the IRA, and same with the sale or refinance proceeds. Is that correct?
Correct. So any investment that the IRA makes. Now there's certain investments too, though, I will say, where an IRA might not own 100% of the investment. So we talk about this pro rata rule. So let's just assume my IRA owns 100% of an investment. Well, then 100% of the profit needs to go back to the IRA, which is good because all the profit is not taxed. Now, if I want to receive my benefit, I take a distribution from the IRA. Right? I fill out a form. I say, okay, I want a distribution. And again, obviously, there's some benefits to waiting to take distributions until you're 59 and a half. Now, there are certain circumstances, though, where, I may partner with my IRA. Let's say I've got $50,000 as me, the individual, and my IRA has $50,000, and we want to buy a $100,000 investment together. Now you may think, well, Nate, I thought you said we can't do that with our IRA. We can't transact with our IRA, right? I can't buy or sell anything between me and the IRA. But me and my IRA can buy something together from a non-disqualified person, provided when the income comes back from that investment that we're partnered on, whatever percentage we're partnered, we have to split the profits according to those percentages. So if we win in 50-50 on the investment, we have to split the profit 50-50. If we win in 70-30, we have to split it 70-30. So as long as we're not commingling funds, right, in that scenario, we're partnering to buy an investment. So let's say me and my IRA wanted to buy an investment from Jeff. We can do that because Jeff's not a disqualified person, and me and my IRA are on the same side of the fence. We just have to make sure that we split the profits based on the percentages we both went in with.
How is that usually done? Is it through an operating agreement that basically states what percentage you own?
Yeah, it depends on the investment. So, for instance, there's some investments it's easy to partner together because the document is just easy to put together. So, for instance, a promissory note. I do a lot of private lending. So, let's say that I wanted to loan, borrower Bob, a real estate flipper in Houston, $100,000, and I wanted to put 50 grand of my own money and then 50 grand of my IRA money. I would have two lenders on the note, right? Nate Hare, and then directed trust company for the benefit of Nate Hare's IRA, right? The difficult part about that is the borrower has to make two payments, right? He can't send all the payment to directed IRA and then directed IRA cut me a check or vice versa. But that's an easy way to put both parties in one investment by just putting two lenders on the note. Now, we do have another solution for investments with more moving parts, or you can even solve that problem too, which is we set up what we call multi-member LLCs, right? A multi-member LLC can be owned by me, the person, and my IRA. And then I can actually just manage the LLC as the fiduciary to my IRA. And that point, my IRA owns 50%, let's just make it easy, 50% of an LLC, and I own 50% of an LLC. But now the LLC is the one doing the investment. So the LLC can go buy a house, the LLC can do a loan, and then all of the income would go back to the LLC bank account. I still got to split profits pro rata when I break that structure down. But the multi-member LLC between IRAs and other people is a good, easy solution to let me navigate and buy anything that I want that'll benefit my IRA and myself.
Right. Okay, that's interesting. So this isn't as common anymore. I think today's generation, people bounce around from job to job. But there are people out there who did the whole work 30 years at one company. They got equity in that company as an employee. And basically when they go to retire, all of their stock is more or less in that one company. I mean, it would depend on how that was structured, if that was retirement or if it wasn't. But how can somebody like that take that and direct it if they want, or would it even make sense? Are they basically 59 and a half at that point anyways?
Are you talking about equity in the retirement account, like a profit sharing plan, or?
Yeah, like I know, so my father-in-law did this. He worked for a major construction company. You get equity in the company. It's a company owned, an employee owned company. And when you leave, you basically have a bunch of stock in that one company. So is that easy to transfer over into a self-directed IRA if you needed to?
No, because it's an asset that he has personally, right? The company gave him stock. So it's just like him having a rental property. It's just a different type of investment. So unfortunately, if it's stock that you own as an individual, there's no way to get it into your retirement account. Now, what I have seen people do is, let's just say that they make a lot of money personally though, and they've got some windfall of money. How can that money be self-directed in a more tax-free manner? Well, if it's just cash or it's investments that you're cashing out of, then we talk about making contributions to your IRAs. Try to get as much money that you can. Now, it's kind of hard because you're limited on how much you can contribute to certain plans. But if you have a call with one of my seasoned staff, we'll talk about all the contribution limits for all plans. So, for instance, I have a lot of self-employed people who maybe even have a side gig, and it's just them. They're a real estate broker, they're a loan. They work for themselves. They have no employees. One of the greatest self-directed vehicles that we have here is a self-directed 401k, self-directed solo 401k to be specific. And those plans allow for very large contributions. So if you've got a windfall of cash, whether it's through equity in a company or you sold off some investments, Bitcoin went to the moon, whatever the case may be, you can start making contributions, and your mindset is, I want to dump as much money as I can so that this money won't be taxed going forward. And the employer plans, the solo 401k, for example, that'll let you get in at least $70,000 a year, as long as you have that amount of income that you can report. And if you've got a spouse that you can also show on that company, she can also throw, or he can also throw in $70,000 a year. So you are limited. That's about the max you can get, is about $140,000 between two people. But then you can go to the other categories, right? You can still max out your IRA contributions. You can max out your HSA contributions. You can set up educational savings accounts for your kids. So again, this is the game that the rich and the wealthy play, is to take the money that they have as an individual and say, okay, I don't want this taxed forever. I need to start dumping this into the different tax advantage or tax exempt plans. And again, once you have them in the plans, then they can be invested in to any investment on the planet, but the gains will be tax free.
Right. So let's say you're I don't want to say a home flipper because they're probably pretty actively involved in their own property, but let's say you're just buying and selling a property every 5 years. Typically you do that, you're going to owe capital gains, long-term capital gains. A lot of people get around that with the 1031. They defer it into a new asset. If you own that property entirely as a retirement account, you don't really have to worry about the 1031 because it's not going to incur taxes on you when you sell.
No, it's easier than a 1031, to be honest, because all the gains are by nature tax deferred because the IRA is tax exempt. So it's already deferred. You don't have to do anything. You don't have to work with a tax deferred company or a 1031 exchange company, and you don't have to pick certain assets and close in a certain amount of time. The IRA is flexible enough where I can buy a rental property in my IRA, leave it there for 5 years, sell it, have a $100,000 gain, and then go invest in a note or go invest in mineral rights or go invest in a private company. There's no restriction because my IRA doesn't have restrictions as to what it can invest in, and it's already tax deferred. Now, what I would always throw out there to people is tax deferral is great, tax elimination is even better. So if you are somebody that can take a small amount of money and make it larger, I would probably say tax deferral is not what you want. You want tax free. And that's why we do a lot of classes on how powerful a self-directed Roth is. That 401k I mentioned with the large contributions, those can be Roth contributions, by the way. So our Roth solo 401k is a great vehicle. Again, that the assets not only grow tax deferred, but when you take distributions at the right time, all of the distributions are tax free forever. So I'll just give you a quick example. I've got a client that owns 12 rental properties in a self-directed Roth IRA in Houston, Texas. Okay, every month 12 renters pay rent to the Roth because that's the owner of the property. Okay? Now he's 59 and a half and he's had the Roth for 5 years, so he has qualified distributions from his Roth, which are tax-free and penalty-free forever. So these 12 renters of these properties owned by his Roth deposit about $25,000, $30,000 a month into the Roth IRA as rent, and then he just takes the rent out to himself as a tax-free distribution. Every single month he does the same thing. So he's living on about $30,000 of tax-free rental income generated from his Roth IRA owned investment properties, and every year the number gets higher because the rents go up. And every year his account value grows because he's never touched the principal of the assets, which are the properties themselves that appreciate over time. So it's the things like that we're not taught that in school. How to preserve wealth, how to create cash flow in a tax-free manner. I mean, if more people were doing that, more people would be already retired. But the problem
Nobody would be working.
Nobody would be working, right? And the IRS wouldn't like that, right? So, but most people, to be honest, most people have a brokerage account and they're retired, and it's a traditional IRA, which they're taxed on every time they take distributions. They have to wait till the market is at a certain point to feel comfortable getting money out or selling some stock to live off of. So you have to sell assets to live off of. You're taxed on it to the day you die. And When you get to 73, they force distributions on you through RMDs. So people are left with less assets to move on to their next generation because they were sold this concept that tax deductions was the way to go, that tax deductions on your income was the way to save on taxes. I hate to tell you, tax deductions will not save you in taxes. Tax-free growth will save you on taxes. And having no tax in retirement and having your assets grow, I've seen more people retire early with that game versus any other game, to be honest.
Right. So let's say you did that. Let's say you're 30 years old, you buy a house. That's it. Just a regular single family house. 30 years go by. You're, what at that point? Terrible at math, but you're at 60, right? You're past 59 and a half, right? So now that money is coming. If you have no mortgage, all the rent you get is tax free. You die at 61 and now it goes to your kids. How does the tax then? Is it still nothing to the kids or is it different at that point?
So it depends on the type of IRA you leave them. So if it's a traditional IRA, right, and you leave that to your beneficiaries or your kids, they get an inherited traditional IRA. So they won't have any early withdrawal penalties because death basically wipes out any early withdrawal for the beneficiaries, but they will have to pay a tax each time because their taxes haven't been paid on it. So again, this is one of the fallacies. It's like, you take your tax deductions so that you take your distributions in your non-working years. Well, then you die and then you pass it to your kids and then they pay taxes in their working years off your assets. So if it's a traditional IRA, your beneficiaries have to pay tax on each distribution they take. Roth IRAs, different. They don't have to pay the tax because you never took a deduction to begin with. So whether you're 59 and a half or whatnot, when you pass that to your heirs, if it's an inherited Roth IRA, they get to take tax-free distributions of those assets for at least 10 years. Which again, 10 years of tax-free dollars is great, especially if you can have assets in the Roth that you pass to them that can't just be liquidated by logging online and pushing a button. Pass them some tangible assets like real estate or a rental property in a Roth IRA. It's going to be hard for them to sell the asset. They might squander the rents, but again, it's an appreciating asset with cash flow in a tax-free manner for 10 years. I mean, those are the types of assets we should be moving to our kids, not just a big stock portfolio that they liquidate the day they see it.
Yeah, exactly. Yeah, that makes a ton of sense. Are there any common myths that you hear a lot about self-directed IRAs? I mean, one I've heard a lot is that you have to be a business owner to be able to do it, which is not true. It sounds like anybody.
No, yeah, I've heard that once or twice. The ones that I hear the most are you can't buy real estate in an IRA without taking money out of the IRA. Again, that's just financial advisors that just don't understand how it works. People think they have to take a distribution to buy real estate. No, you don't have to do that. The whole self-dealing thing gets a little hairy. Again, you can't buy or sell things between you or the IRA. You are supposed to find investments for your IRA to buy. So that sometimes people get confused that when they're finding an asset for their IRA or finding a property for their IRA to buy, they're somehow doing something that's prohibited. No, that's what you're supposed to do. You're supposed to find investments. You just have to buy it in the name of your IRA, and you can't sell your own stuff to your IRA. So the whole disqualified people and prohibited transaction stuff gets a little confusing. And they also think that it's our rule when it's no, it's the IRS's rule. It's the same rule as F Fidelity. They just don't have to explain it to you because you're only buying things from Wall Street. You can't use a Fidelity IRA to buy your own stuff. So it's the mere fact that they won't allow you to do it anyways, that they don't have to have the conversation. But when you have a self-directed IRA, you do have to understand the rules because, again, it's a little bit entrepreneurial of account. And you're going to tell us what the investment is, so we just try to educate you ahead of time that, okay, don't bring us a purchase contract that we're buying your house, or don't send us a contract that we're buying a house that you're going to homestead and live in. That's not the purpose of a retirement account. It just has to be an investment. The investment profit has to go back to the IRA, right? And then you get benefit from the distributions. But as far as what it owns, it can own anything on the planet. You just have to find a custodian that will manage the asset or buy the asset on your behalf.
I think on one of the emails you guys sent me, it even talked about somebody investing cattle with his IRA.
Yeah, cattle, livestock. I had a client own a thoroughbred in his IRA. It was really weird. I don't want to get too nerdy, but it was really weird because he had RMDs. He had RMDs at one point. We're like, how do you take an RMD of a horse? You know, how do you take a, you know what I mean? Because you're only taking a portion of it. Are we taking the hoof? Are we taking the, so again, some of the assets that we get, you're like, kind of throws you for a loop. How do we process this and have paper trail for it? So it can be kind of fun at some point. But again, not everybody is buying kind of that off the wall stuff. Most people are buying, you know, I would say the most common investments you see in any self-directed IRA company are passive real estate investments, right? Investments into syndications, mobile home parks, commercial property, you know, those types of things. I wouldn't even say most of our clients are active real estate investors. We've kind of talked a lot about that just for conceptual purposes, but only about 5%, maybe 7% of my clients are active investors. Like they're going to find a property that's going to be owned in their IRA. They're negotiating with the seller. Like they're doing all of that legwork. That's not our typical avatar client. Our typical avatar client is somebody that worked a W-2 job. They have a decent amount of 401k. They don't want to do the stock market anymore. They're just tired of that roller coaster, and they met somebody that's got a real estate deal. So they're going to invest their IRA with that person, and that person's going to do all the work, and that person's a non-disqualified person, right? So that's 90% of what we do is people just telling us, I'm investing in this deal, I'm investing in this mobile home park, I'm investing in this syndication, and you're not even limited to the United States. I have clients that invest in real estate deals in Belize and you know, offshore. So again, that's where the magic is just investing in, you know, what you feel is more powerful or safer in your retirement account. And if it's real estate, I mean, you think about it, real estate's the largest segment of our economy. It's not going anywhere. There's cycles just like anything else. But the fact that real estate has multiple streams of income, and people would argue that we're turning it more into a rental society. I mean, rental property and those investments are always going to be attractive, and you don't have to just invest your personal money as a taxpayer into those deals. You can also invest your qualified non-taxable money into those types of deals as well through a self-directed IRA.
Well, with real estate, it works better the longer you wait. And through a retirement account, it's perfect because you have to wait anyways. I mean, there's no sense in trying to get complicated with it. If you can't touch it till you're 59,
Right.
then put it in something that does really, really well in the long run. But here's another question. The last question I got on before I let you go. In terms of, let's say you do really, really well. You start in your mid-20s, like early 40s. You look at the distributions that your retirement account is getting, and you can say, hey, I could start living off these distributions now. Mm-hmm. What are your options? I mean, can you just not touch it, or do you just have to pay tax on or a penalty if you do touch the distributions?
Okay, so I just want to clarify the question. Are you talking about if I want to take distributions before 59 and a half, what happens?
Yep.
Okay.
Yep.
So if it's a traditional IRA, the additional thing that you'd have to pay if you take a distribution before 59 and a half is the pesky 10% early withdrawal penalty. So you got to pay the taxes on the withdrawal, and you got to pay the penalty. Again, this is where I love the Roth IRA. Roth IRAs, first, the money you take out of a Roth IRA comes in a certain order. Any contributions I made to my Roth IRA, since those were after-tax contributions, I never got a deduction, I can take my contributions out anytime at any age, no taxes, no penalties, right? So my contributions come out first. Second would be any conversions, and then third, any earnings that I take out. If I take out all my contributions and I start taking out my earnings, I could be subject to a penalty taking out earnings. Now, what I try to tell people is try to build your Roth IRA up to a certain point to where you just invest everything. Every investment you find is bought by your Roth IRA, and just live tax-free off the distributions. Now, if you're retiring earlier, there are some provisions that allow you to take distributions penalty-free before 59 and a half. It's called a 72T. Again, I don't know that is the wisest thing to do, but I've had some clients, a lot of, I will say professional athletes will do that because they're, retired at age 35. So they take that provision. But really the Roth, the account, like you said, I mean, time's on your side to grow these plans. And if you could stack enough assets in a self-directed Roth, assets that appreciate over time, assets that cash flow, assets tied to real estate that always go up. I mean, you could really live tax free forever just off of the cash flow those assets give you. And even, I wouldn't even look past lending. I mean, I lend and I get double digit returns backed by real estate just being a private money lender with my IRAs, and I don't have to deal with the toilets. I don't have to deal with the tenants. I get tax free income through the interest payments from my borrower. There's no tax benefit to me lending my own money, but there's massive tax benefits to loaning my IRA funds. And even if I have, let's say, I don't know, $2 million, in a Roth IRA, which doesn't seem like a lot nowadays. I don't know why, but it's like if I loan that out and if I can get a generous 10 or 12% return, I mean that's like $200,000 a year to me, tax free. I just need to get to that point and make sure my money is deployed in an asset that pays monthly. And real estate's one of the greatest investments on the planet that pays monthly. So it's like, why would you not want to marry those two ideas together? And why would you just chance the stock market and hoping it goes up when it seems like it's always going down?
Right.
Yeah.
Nice. Well, you never know. Dogecoin. That's what is funny. When I was in the Navy, for a while I was the command financial special, and that's what I always got questions about. Never questions about retirement accounts.
Yeah.
Always about the next.
Right.
next
Well, they say,
coin.
95% of millionaires, I know it's a cheesy line, but it's true. 95% of millionaires make their money in real estate, and 97% of us invest our retirement in the stock market. It's like those two numbers should be closer to.
Yeah. I totally agree. Well, on that point, let's say people want to take the first step and they want to get going with you guys. What is the best way to get in contact with you, and how does that whole process work?
Yeah, I would say just go to our website, directedira.com. First, we've got a ton of education. I would say, get comfortable with the product, get comfortable with the process. If you want to schedule a call with me or my team, just click the schedule a call button, book a call. You can find me, myself. I love having consultations, and just making sure that you understand the process and make sure it's a good fit for you. Because self-directed is not for everybody. If you think that your money is going to sit here and it's going to grow without you doing anything, that's not what a self-directed IRA does. But if you are an entrepreneurial type of investor and you kind of have an idea of what you want to invest in, that's somebody that fits the avatar. And if you've got a retirement account, we'll talk about how to open the account, how to move the money, how to deploy it. But that's best done on a call versus email, I think. So just go to our website, directedira.com, and you can find a way to get in contact with me or my team.
Awesome. Nate, I really appreciate it. This has been super informative. I'm sure a lot of people are going to find a lot of use out of this. So I really appreciate you taking the time.
Awesome. Well, thanks for having me. I appreciate it.
Thanks, Nate. See you.